Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Let's go. I've got another great episode for you. Thanks for stopping by. Before we get there, just a couple reminders. I think it's the 10-minute clips on YouTube. The reason why I'm so excited about those at my YouTube channel is just because you get to look at us. When you're listening to a podcast, you're getting all the good information in your car while you're walking, while you're exercising, whatever you're doing, but you can't really connect with the people. So if you just watch these 10-minute highlight clips on my YouTube channel at Jonathan Green RE, you can see us and then you can go back and then you have a face to the name. That's how it works. This week we have a 2-person episode and this is tax related. So get ready. We're going to talk about elevating your business and personal wealth with Brady Slack and Mike Scicluna from High Country Finance. Let's go. Episode 79 of Zen and the Art of Real Estate Investing with my guests. Yes, another 2-person show, Brady Slack and Mike Scicluna. They are the founders of High Country Finance. They specialize in helping business owners, independent contractors, entrepreneurs, and real estate investors reduce their tax bill and elevate their business and personal wealth. Mike, Brady, welcome to the show.
Thanks for having us.
Thanks for having us.
Yeah, excited to talk to you guys. It's always good to have a tax-friendly episode because there's lots of investors like myself who've just been blundering themselves through the years. Let's actually just start with a quick question about taxes. Where is the biggest place that people are making mistakes as real estate investors right now in each of your opinions? Tax-wise, of course.
Go for it, Mike.
Yeah, I was going to say, I think the biggest mistake is trying to read the market and play the market in real estate. And then on the flip side, trying to use real estate just for taxes. I think that taxes can be a huge benefit, but you've got to do real estate when it makes sense for your financial journey, not read the market and not just try and save taxes this year, because it's a tax deferral, not necessarily a tax elimination that you use with real estate. So I think people are going to listen to their CPA sometimes and say, oh, well, let me just go buy assets that I can depreciate. That depreciation can come back to bite you in the butt if you don't do it right.
Yeah, I agree with that. Brady, I'll let you weigh in and then I'll throw in my opinion.
Well, I think I know where you're going to go with that, so that's okay. I'm actually kind of surprised Mike didn't say what I was thinking. I think one of the biggest deficiencies that individuals have when it comes to real estate and taxes is they don't pay close enough attention to the actual accounting or entity structure. And I think without knowing it, that comes back to bite them when they don't have all the deductions that they could use to offset some of their rental real estate income, or they don't have the proper entity structure, which is maybe also having to deal with the legality of their structure. That I think those are some big problems that people run into. Yeah,
I like those both. For yours, Mike, I always have this thing. I have friends who will say like, "Oh, I need to buy something to depreciate," and I just grew up with my dad saying like, "That's not a good idea," because you're kind of exactly like you were saying, like you're forcing a purchase to create a depreciation that may or may not really work out long term, and then the asset still has to perform. Also, that's what you're talking about, right? I find this really harder in real estate. Before I get to Brady's point, like what type of asset are you buying that you can depreciate rapidly enough in real estate where it would make sense?
So a multifamily property, you can actually depreciate using a cost segregation, and Brady can talk a little bit more about that. The tax savings on that can be quite significant. If you have something like a 16-plex, you can offset upwards of $1 million in revenue. In net income, really. But it's not worth it if you're losing money on the property. So if you were to buy a 16-plex and you're negative $2,000 a month, and you think, oh, it's negative $2,000, but I'm saving $300,000 in taxes this year. You're not saving, you're deferring. And if you're not making money on that property, then it's probably not going to be making sense. And that's, to Brady's point there, don't get into real estate just because it seems like you're going to save some taxes. You need to actually look at all the numbers. And this is what I spend a lot of my time doing is ROI analysis of investments. If you're looking at putting, let's just say $1 million into a property or something like that, you need to look at the future value of that cash. And if the future value of that cash compared to the present value is not going to at least give you a 10% return, then you're not even doing better than the stock market. And then, like when you do an ROI analysis, you take into consideration the depreciation and the tax savings, and you take into consideration the revenue that you're making and maybe some expenses that you're saving on in a business. You've got to be making good amounts of money on an investment like that when you're looking at the future value of the cash compared to the present.
Yeah, that makes sense. And cost segregation analysis is complicated. It's not something that just anybody can just do on the back of their hand to make it work. Brady, what do you think about the cost seg analysis? And that's not for everybody. I mean, I feel like that's a difficult thing to pull off the right way.
I think it could be for everyone. A common phrase that I use with clients is it's not a matter of if you can, but how can you, and before we hit record here, Jonathan, you were asking a little bit about like real estate professional status, and I'd like not to take any of your thunder, but it's a perfect segue into that conversation.
Yeah.
If there's probably a lot of argument to be had for if you're not a real estate professional, does it make sense to do a cost segregation analysis? And odds are is it doesn't. The cost segregation analysis, if or how you could be considered a real estate professional, it's probably one of the easiest tax strategy opportunities there is. But again, like Mike said, if you can't utilize that depreciation, we're trying to have a conversation about why we should or should not let the tax tail wag the dog. And, I agree with you. And Mike, I don't think buying a vehicle every year is the best way to write something off to save money on taxes.
Yeah, I think when I had Tom on, we've talked about it. When I had Tom Wheelwright on, he was saying that, the tax code's there for a reason. You guys know the tax code. Your job is to help investors and obviously other business people save money. But I feel like some people in this context of what we're talking about take it too far. They're like trying to fit pieces into a puzzle just to get things. And then you're just creating more problems long term.
Yeah, I would agree. I think like right now you'll see a common strategy that people will kind of talk about on social media, where you go buy an Airbnb property, provide substantial services in the Airbnb, and then you can use it as an active or ordinary business to do a cost segregation on, and all the losses are treated as active or ordinary losses rather than passive losses. And again, not that I'm saying that's a bad strategy, but does it really fit into your financial plan? And is that what you're trying to accomplish long term, where you have to spend more time just to get a tax benefit? You hear the word passive income, it's kind of clickbaity, if you will. But I think a lot of people who have that money are trying to create opportunities for themselves where maybe they don't have to participate in the activity that much, or maybe it is more of a passive activity investment as far as time goes. So yeah, there are some clickbaity opportunities, but again, I would relate that back to not a matter of if you can, but how can you?
Yeah, that makes sense. I mean, I feel like taxes can be like a real mystery to people, even someone like myself who's been in it a long time. My dad worked for the IRS. It's almost like a scary thing. How do you guys kind of get across to clients, real estate or business otherwise, how important it is to kind of understand what you were saying before, what they're putting in, and how are they setting themselves up for the long term early instead of too late?
I think like the first thought that comes to my mind is the word audit. Again, like a lot of people are scared of an audit. If you do things right, you set up your bank accounts right, you have good accounting principles, your entity structure is correct, and you're working on a tax plan with an advisor, then I think that audit word really just needs to be replaced with checkup. If you have clients that are getting audited every year, you look at high net worth individuals, odds are they are getting audited every year because they have vast amounts of opportunity that the IRS sees as potential revenue for them. But if you're doing everything correct, why are you afraid? It's just a health checkup with the IRS, making sure that all of your financial procedures are in play. So that would be my recommendation. I don't know if Mike has anything to add to that.
Yeah, I think it's important to understand that the tax code is vast and there's a lot that goes into the tax code. And the majority of the tax code is ways for you to save on taxes. It's either credits or deductions, ways for you to pay less in taxes. And because there's so much in the tax code, you as a business owner understand what's going on in your business better than anyone. And no matter how good your CPA is, they're never going to understand the business like you do. So I think it's important for you to, Brady mentioned that there's some clickbaity things on Instagram or TikTok and other platforms that, you hear something you're like, this person saying you can save $1 billion on taxes if you just do this one thing. A lot of them are quite clickbaity, but I think it's important to have a tax professional that you're working with, that when you get one of these clickbaity things, you can send it to them or talk to them about it and just say, hey, is this a reality? And is this something that could work for me? Because that conversation can quite often help you to come up with, even if it's not the exact strategy that you're hearing on this, reel or whatever you're watching, it may help you and your CPA to come up with a solution that does work for your business. And the thing is, I doubt that there are very many businesses out there that are actually taking advantage of every single tax strategy that they could. There's just so much that is possible that if you as a business owner are not actively thinking about, well, what more could I do? What more could I save on? The chances of you thinking of everything are actually very slim. And your CPA is going to help you with the things that they are used to and the things that they understand, but they're not going to think of everything either. And this isn't to bash on any CPA. It's just a matter of the market. There's just so much potential opportunity, and you understand that how your business functions and what's going on in your business. They're not going to see every nook and cranny of your business. So you need to bring things to their attention and say, hey, by the way, there's this thing that I'm doing. Could this be done in a different way? Or could this, right in the way that it's been doing right now, save me taxes in some form or the other?
Yeah, I agree with that. And I kind of liken accountants who have real estate expertise to realtors who have investing expertise, because your general realtor doesn't know anything about investing. So they can go look at a multifamily and just look at comps and say that's good, but they're not thinking about rent roll, deferred maintenance, potential tenancies, how you're going to rent it. And I think it's the same, especially with my experience over the years with just using a general accountant. I'm not getting the questions on the real estate that I need to make sure that I'm, at least activating on some of these depreciation or potential options that are going to save me money. And they just might not know. And then that's on me for not, like you said, having this, discussion about this is all the things that I'm doing, where are ways that I can maximize in advance. Because in the end, you're just trying to fit pieces in. And then I think it's too late. So it's like, right now, if I was to get somebody new, I'm like thinking like, hey, how can I do this for next year so we're all on the same page? Does that make sense?
Yeah, and that's actually, it's quite common that it comes, March or April when it's time to actually file taxes for last year that someone says, oh, by the way, I did this thing. And you're like, oh, wow, if you had told us about that when you were doing it, we could have set things up in a way that we could have saved you a lot of taxes. But do you know what I mean? Like it's like they purchased a property in their personal name without a real estate professional license, or they didn't put it under an LLC. There's so many things that you can, you do the action, but you don't set it up correctly, and then you miss out on the opportunity.
Yeah, I think you just described my life. Yeah, my life as it relates to accounting. How many different ways can I screw this up? But I have a lot of friends who are the same. It's just like you kind of just do it because you figure like, oh, formation later, but like I got to get it in order. Brady, let's talk a little bit about entity structure because you brought that up. If you look across bigger pockets, probably the question that's asked the most is like from a baby investor who says, should I start an LLC? Yeah. So I know that it's not as important as people think, but it is important. But you can't use an LLC for most parts to buy if you're using a mortgage, unless it's a community bank sometime. So where does the entity structure come into play that can help somebody long term?
Yeah, really great question. I'll preface the question by stating that CPA also stands for cannot protect assets. So part of the entity question comes into play with a conversation with an attorney and your specific kind of plan or financial structure. But when we talk about entities, the biggest reason why we talk about entities when it comes to real estate, it does have to deal with the liability of a rental real estate property, and not because we want to get sued, but it again, just planning and protecting ourselves. Now, again, I'm also not a mortgage lender. I'm not in title. However, the majority of our clients are able to set up an LLC sometime in the closing or shortly thereafter, and with a quick claim deed, assign that property to the LLC. I will speak on the fact that the reason we use LLCs when it relates to real estate has to do with the fact that it's an asset. The property is an asset. And if you own that asset in a C corporation or an S corporation and try and sell the asset or perform a 1031 exchange, you have new basis in the asset, which could cause unintended tax consequences to the basis or the shareholder basis of that stock in the corporation. Whereas in LLCs, I can sell property, transfer property without causing any changes to a basis in stock. The other thing I'll mention, it's funny, I had this conversation I'm looking at my calendar, 2 hours ago with another client that we were going over entity structures, and they're purchasing a couple properties before the end of the year. And the other question I get is, how many properties should I put into one LLC, or do I need multiple LLCs for every property? And there are some situations where you would need a separate LLC for a separate property. I have some clients who own multiple properties, 10, 12, 15 properties with one LLC, and that's fine. They understand the risks that would be associated with that when it comes to liability. And then I have some clients who maybe own a larger property like what Mike was talking about and separate that into its own LLC because it comes with its own equity and risks. And then they invest multi-state, and each state has a separate LLC for the properties that they own. But again, it's a team effort, right? You talked a little bit, we podcast swap, Jonathan, but we talked about your team, last week in our conversation. And it's important to have a team. It's important to be communicative with that team. And typically in that team is going to be your accountant and attorney to help you walk through what that process should look like as it relates to you.
Yeah. Before I get your opinion, Mike, I have like 14 LLCs. My sister and I have like 6. I have like maybe 6 at least of my own, and then a couple other stragglers. But the main concern is if you put multiple properties in one LLC, is that one property will get sued, which will jeopardize the other properties
Correct.
that are in the LLC, correct?
Yeah, that's the conversation that I see. Now, again, I go back to this stating that when you own a business or when you own a rental real estate, having an entity does not allow you or disallow you to deduct any additional expenses. I can have an LLC and deduct the exact same expenses as it relates to the rental property that someone who might not have an LLC does. And to be quite honest with you, on paper, rental real estate should be a loss. Unless you're just absolutely crushing it, in which case buy something else with the proceeds to offset it with depreciation, right? But rental real estate on paper should always be a loss. And so therefore, because I'm not concerned about the tax consequence, and by technicality, it is considered passive, not subject to self-employment taxes, we use LLCs because at that point, it does become a liability conversation.
Yeah, I always have a blanket insurance policy, which is something that makes me feel better if I'm playing around with LLCs or one isn't necessary. There are a couple issues, and I should have said before, like if you have an LLC and you have 2 years of tax returns on that LLC, like you're going to be fine. You actually can get a mortgage with that LLC if it's making enough money. But it's like that question always comes up. It's the number one. I know it is on Bigger Pockets. They're like, I'm 3 years out from investing. How many LLCs should I start right now? And you're like,
just get proof of concept. Go make $1. Get proof of concept, and then we'll have a conversation.
Yeah. Mike, do you want to weigh in on the LLC conversation that Brady and I are having?
Yeah, I think it's important to understand the basis of an asset. I think most people don't understand what a basis is and how it affects the value of an asset. So most people, when they get into real estate, they're going to get a loan. And if you're in Bigger Pockets and chances are in this world, you're not putting down a 20% deposit. You're trying to get a 0% if you can, or as close to that as you possibly can. So let's imagine that you've got a $500,000 house that you purchase. You're thinking, well, that's a $500,000 asset. Not so. You actually have about a $15,000 asset when it comes to legality.
Everyone just jumped out the window, Mike. Thanks.
Yeah, there you go. Now that asset you'll get appreciation over time. You'll pay down the loan. There's so many benefits to that. But if I'm a lawyer and I'm coming to sue someone, and this is where lawyers are a little sneaky here, they actually do their research on people before they take on a project to go and sue. And if they look at your assets and they can figure out, what businesses you own and the value of those businesses, or the assets in property and different things that you own, they'll actually determine if there's enough to go after. And we've actually had a client that for a while there was getting sued left, right, and center because he had a lot of risky open areas where he could have been sued, and he did have a lot of value in his assets. But if you go out and you buy 10 properties, and each of those properties you put 3% down, then you only actually have available to someone that is trying to sue you that 3%, because the value of the asset minus the loan is what they can get out of you. Plus, they actually have to get the value of that asset somehow, either by, if they obtain the property and then they want to sell it, they can assume the property, but they would also have to take on the loan, because that lien is first and foremost to the bank. So this is where quite often people think, well, I just need to get an LLC for each property. You don't really need to get an LLC for each property until you actually have a substantial amount of equity in each of those properties. Now, that equity can go up very fast if the value of properties are going up fast. But if right now the value of properties are not going up very fast, and so you could have quite a few of your properties all under one LLC and actually not have that much value that can be taken from you in a lawsuit, if that makes sense. So that's just one thing to consider when you're looking at the prospect of, should I have separate LLCs, or when should I get separate LLCs? Because what you got to understand is, Jonathan, I'm sure you understand this. When you have 14 different LLCs, that's 14 different financials that you need to keep. And on my side of the company, I'm the one that takes care of that. And that's a lot of work. When you could put it all into one, it's definitely going to reduce the amount of headache and overhead that you have to handle.
Yeah, I guess it's like panic setting. You try to get everything separated at a time. We were putting one property in each. And then, here, and I just have different businesses for LLCs. But yeah, it's a lot. I mean, I think this is a question that get asked a lot. So I think they just got a ton of information from you guys that can help them. They might want to rewind and go again, because it's important to figure out. And you said before, Brady, this is a conversation for you to have when you're building your team. And part of your team is a tax professional who can help you, but you have to let them know in advance, like Mike said before, of what you're planning, so you can make sure to at least maximize the benefits, or understand, if you do make this purchase, what could come of it. Let's talk a little bit about that real estate professional. That's always been interesting to me. I didn't really actually know about it, which is crazy, because I probably could have used it to my advantage, and still do not. But explain what you have to do to get it and who it's ideally suited for.
Great. Yeah, really great. I'm actually kind of shocked, Jonathan, that based on my knowledge of what you do, I'm kind of shocked about the real estate professional status there. So,
me too.
So real estate, by technicality, is a passive income producing activity. Okay. Which means it has its own rules about what losses can offset incomes, and passive activity loss rules. But when it comes to real estate specifically, there are 3 ways that an investor can be classified. The first way is a passive real estate investor. Typically, this is someone who might be just putting money into a syndication or a fund and gets a mailbox money, every month or every quarter. That's how I typically see it. Then you have, and the tax consequence of a passive investor is you can only use those passive losses to offset other passive incomes. Maybe you have portfolio income, passive business income, whatever that might look like. The second type of investor when it comes to real estate is an active real estate investor. This is someone who has what the IRS defines as material participation in the activity, or they spend time in the business, whether that's managing the property, doing renovations, looking for new properties, whatever that might entail. And the benefit of being an active real estate investor is that you can use certain passive losses to offset ordinary incomes, whether that's W-2 income or business income. Now, there are some limitations to that. If I make over $100,000 in adjusted gross income, I start to phase out, and I can only use up to $25,000 of those losses. If I make over $150,000, I'm phased out and can no longer use any of those passive losses against active income, just passive income at that point. And then there's the third status, which is this real estate professional status. There's a few different tests that you need to meet in order to be classified as a real estate professional. Typically, the most common or the most used in the examples as far as audit techniques go in the real estate professional guide are that I have to, more than 50% of the services that I provide during the year have to be in real property. Again, what is real property defined as? Property management, maintaining my properties, cleaning my properties. It could even be something as far as real estate, title, mortgage, construction. As long as if I'm a W-2, I own at least 5% of the company that I'm working for. So there's quite a few different opportunities there. And then typically the second test is that I have to spend at least 750 hours a year in the activity, as well as maybe some other hourly requirements for certain properties with property managers and things like that. The benefit of being a real estate professional is that all of my passive losses from real estate are not subject to passive activity loss rules and can offset any and all other ordinary or active income, such as business income or W-2 income. So that it's a very powerful tool when used right.
Does that only apply to the investment side? Like, what about real estate agents? Obviously, I'm licensed also, who are operating in real estate 24/7. But what if they don't, they have one investment?
So again, it's going to come back to that hour rule. As long as I'm spending at least 750 hours in that activity, then you would be able to qualify for it. All of your time is spent in real estate, but as long as you're meeting hour requirements for your properties, and there are some other hour requirements typically used as well for testing requirements, like I have to work at least 100 hours more than any other person working on my property during the year, right. Different things like that. But yeah, that's why I'm kind of shocked that based on your hours, if we would write those down, why you wouldn't qualify for it.
I think I could get the 750 in a week, even though that's not possible. I could do it. Mike, have you seen the benefits of this real estate professional status as well? It's something that gets talked about, but I don't know a lot of people who actually talk about it like, hey, I have this and it's helping me.
Yeah, I think that real estate is like it's an onion. It's got lots of layers. And I think most people just scratch the surface as far as getting into real estate. They see that monthly income coming in, and they may get a bit of depreciation or some helpful things on their taxes, but there's so much benefit that you can get out of real estate that most people just miss it. I'd say that at least 50% of the clients that we have that are currently real estate professionals were not real estate professionals when they came to us. And it's not because they didn't want to be, it's just because they didn't know that was even an option. It's just not something that I think is talked about enough just in the circles of real estate investing. Most people just don't really think of that. Now, I will say that for some of you out there, you're thinking, okay, 750 hours, like I've got my day job and I'm doing, at the moment, I've got my properties on the side and that's where I'm starting to build my portfolio. And maybe eventually I'll get to the point where I could do that, but it can be hard to get there. A lot of our clients will actually have their spouse. Usually it would be like a stay-at-home mom, that they'll actually have their spouse who also partly owns these properties become the real estate professional in that arrangement. So if you personally are working a whole bunch of hours on something else and you're thinking, I really can't put this much time into it, and in some cases because of your W-2 payment, it wouldn't actually be possible for you to do it. If you have a spouse that is staying at home, taking care of the kids, and they're not, working a full-time job, it's a really good opportunity for you to potentially have them become a real estate professional And in some cases, it's going to actually save you a lot more money and be much more worth it to you than having them go to work at a full-time job.
I can see that really working for military couples where one's deployed and one's not, because a lot of military personnel, we've had several on the show, are getting their journey started while they're deployed, researching, and then a spouse is at home, with kids or kids on the way.
Mm-hmm.
That seems like a good use of that, because they're getting involved together, but the deployments come and go. So there's options there for that to work.
Yeah, for sure.
I would say we also see it a lot with, like, we work with a lot of sales organizations, and those sales agents, they'll go make, whether it be like solar, real estate, whatever that might be, they go make a lot of money and then they put that money right into real estate. Well, they have a spouse who doesn't need to work because they're making really good money that can help manage and look for and investigate and run numbers on properties. And I think another opportunity, you mentioned it briefly, this is why I think about it, Jonathan, another opportunity are individuals who are in professional careers, whether that be law or dentistry or doctor's offices. Again, they have very healthy incomes that they can then go purchase real estate and have a spouse help, again, manage, decorate, clean, whatever that might be on those properties to help offset the taxes that they have to pay on the income they earn.
Yeah, that makes sense. Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there. Important too. These things that we're talking about now, they're not flashy. So like and Brady and I were talking about this on his podcast, Slacking Off, there's so many shiny objects out there now that what we were calling, and you said it called, financial porn. It's like that. It's not flashy to talk really about 1031s. They talk about it and then they ruin it, as if it's like the easiest thing ever, when we're definitely going to get into that. But like, this real estate professional thing, like, I honestly really didn't hear it that much, and I don't see it. I'm much more seeing somebody pull up in a Ferrari and saying like, "Hey, I just depreciated this. It's great," and then they get in an accident 5 seconds later. But maybe that's part of the problem. The things that tax is not flashy.
Yeah,
no,
and maybe
really
that's
not.
why people are missing out on getting set up.
Well, in taxes, you always say pigs eat and hogs get slaughtered. And the people that like. This is a real estate professional is a very technical term. Like, there's lots that goes into it. You have to have logs. You have to keep hour requirements. You have to show what you're doing on each property and how you're maintaining those requirements so that you qualify for it. And the reason is because, again, like I said, it's one of the biggest opportunities to save money on taxes. We have clients who are set up as real estate professionals, either due to a spouse or time spent in one activity versus another activity, who might have business income, passive or active, in the millions of dollars, but are able to have such a low, sometimes even negative effective tax rate because of this real estate professional status. So, I would argue, or I would comment, that the reason you probably don't hear about it is the people that are talking about all these other tax loops maybe don't know what they're talking about. And so when it comes to the real technical aspects of tax, they can't provide an answer on it. So they don't talk about it. And, there's your sign, I guess you would say.
Yeah. Go ahead, Mike. I know you had something on that as well.
Yeah, I think that when it comes to these strategies, tax is not sexy. In fact, when it comes to business, it's the least sexy thing that you can possibly talk about. There are some aspects of it that you can try to make a little bit sexier, but the majority of tax is just not sexy. Unfortunately, most of the people that talk about tax are not all that sexy either. We're trying to change that in the industry right now with me and Brady. But
hey now, speak for yourself, man.
So I think that, again, it goes back to, as a business owner, you need to be actively going to your CPA or the person that's doing your taxes and talking to them about what you're doing, where you want to end up, how you want to build your essentially your real estate portfolio as a retirement plan, if that's what your goal is. But I'll add on to this: if you have a CPA that works for the IRS, they're not going to talk to you about things like becoming a real estate professional or things that you may not have heard of before unless you specifically bring them up. You need to find a CPA that's in your corner, that's working for you, someone that is going to be, not ever cross a line, but be aggressive about trying to find ways that you can save taxes rather than just sitting there and saying, well, we'll do the bare minimum and then whatever you have to pay is what you have to pay. I think that's really important as a business owner that, if you're an entrepreneur and you're hustling and you're growing, why would you not want to work with a CPA that is also a business owner that's hustling and growing and, doing the things and living the life that you want to live? That is really important. A lot of CPAs are not living the life you want to be living, but you can find them out there. There are some CPAs out there that, really are actual entrepreneurs. They're not just numbers guys that, got a degree in accounting.
Yeah, it is. It's just one of those things that people are worried about getting into, but then they can see the benefits of it later. But it's still hard to keep up with. I mean, don't you think one of the biggest problems with investors, I mean, actually, this is just with everybody with a business, it's just bookkeeping. Because that's what leads you down the rabbit hole and makes your guy's job harder later, when they say like, oh, well, I haven't kept track of anything, help. Which I've definitely done to people in the past. But how important is bookkeeping for not just investors, but business owners?
So Brady actually brought me into the business because of how much of a pain bookkeeping was. Because of that exact thing that would happen is people would come to him and say, here's my books, or I don't have any books. I'll tell you that so Brady and I as business partners, we're the perfect combination because Brady does all the things that I don't want to do and I do all the things that he doesn't want to do. It works really well. So Brady is the tax guru. He knows exactly what he's doing there. He works on everything to do with taxes. I'm in charge of bookkeeping, accounting, and CFO and all those services in our company. And I'll tell you this right now, 9 times out of 10, the sales process for me is quite simple because all I need to do is when we have a new client come along, I say, okay, well, just show me your books, what you've got right now. And we just sit there for 15 minutes and I just point out all the things that we need to fix. And it's like, oh, wow, my books are really that bad. I had no idea. And sometimes it's because they're doing it themselves. Sometimes it's because their mom's doing it. And sometimes it's because they've just, tried to go cheap on a bookkeeper or, hired someone overseas or something like that. It causes a lot of problems. And in quite a few cases, what will happen is we'll actually clean up their books from previous years and then file an amended tax return and save them money on previous years because their books had been so bad that they'd actually missed out on a lot of tax savings because of that. So you potentially could be missing, in what we've seen, up to tens of thousands of dollars in tax savings by not having your books done correctly.
I'll add on to it, Jonathan, really quick. The tax return is a byproduct of the reporting and planning that is done during the year. So and I understand what I'm about to say, but most people, if not the majority of people, they view tax prep and accounting as a cost because it's not fun. It doesn't provide me with a direct ROI or a direct revenue generator, which like I said, I understand that because even for us, we have to view things in a way that helps business owners and investors see an ROI, right? But unfortunately, what they don't realize is that the planning and the preparation that goes into things during the year is a direct reflection on what you're going to pay in a tax. And if it's not prepared correctly, you are going to pay higher tax. And when it comes down to it, because you didn't put in that time, I'm not going to be able to do a whole lot after December 31 to help you, reduce that tax bill. So how important is it? It's a foundational piece to the amount of money that you're going to pay Uncle Sam or potentially not going to pay Uncle Sam when it comes time to file the tax return.
Yeah. So in regard to not paying, let's talk 1031 exchanges. So I haven't used them very often just because I feel pressured. Can you go over the guidelines for 1031? And then I can talk about why I feel like it's like a pressure cooker. And I think people make a lot of bad decisions forcing their way into 1031s.
Real quick, before Brady goes into the details of that, I just wanted to mention far too often we have people come to us 2 months after selling a property and they'll say, hey, I want a 1031 exchange this. It doesn't work like that. And again, that's they've watched some or listened to or something. They've got some of that financial porn. So listen very carefully to what Brady's going to say here, because it can be done and it can be a great tool. But if you don't do it right, you're going to shoot yourself in the foot.
No, it happens more often than it should, to be honest. I'm actually really, I'll give kind of an overview, but I'm really curious to hear why you feel pressure, Jonathan.
Yeah.
So when you hear 1031 exchange, you're simply referring to IRS, Internal Revenue Code section 1031, which is an exchange of like kind assets. Okay, specifically related to real estate, meaning I take a property and essentially trade it for another property of equal or greater value. I can also trade one property and into multiple properties that have an equal or greater value. Typically, the reason why you would enter into a 1031 exchange is because you have a good amount of equity in the property and you want to utilize that equity to grow your portfolio or get into something bigger. What you meant, the tax consequence of a 1031 exchange would be that I take the property that I currently own, and instead of selling it and executing a capital gain transaction that I would owe a tax on, I trade it through a 1031 exchange that allows me to basically change the basis for an adjusted basis in the new property and avoid having to pay a capital gains tax on the property. Again, I think this is another tool that a lot of people don't talk about. There are some technicalities to it. And in fact, this is something where, my team would help you calculate your adjusted basis. What's your basis going into the next property so that we know what we can depreciate on that next property. But a lot of it needs to be done with an exchange intermediary, a title company, to make sure that they hold funds for reporting requirements as far as the timelines go with the 1031 exchange. But they can be pretty technical. But I've seen some clients build vast amounts of wealth in real estate through 1031 exchanges. In fact, I can think of one right now he probably had a 40 or a 50 unit apartment complex a couple years ago. And last year they executed an exchange and traded it for, I think the new property had like 80 to 90 units. So they increased doors by 40 to 50 units in one transaction, but their net profit went from, I can't remember what it was, maybe 1.2 million to like 2 million. So they increased cash flows by $800,000. Again, great opportunity to just increase the portfolio and grow when you have the equity. So hopefully that helps. But I'm interested to hear what your take is on it, Jonathan.
Well, you have a limited time frame to not just choose the properties, but to purchase the properties. And I believe you have to purchase the properties from your little lot of 3. So if you're stuck in a very tight, no inventory market like we're in, your identification of properties could fail pretty quickly. Also, I personally, I'm licensed, I have access to everything. But if you have a bad real estate agent, you could be in big trouble locating properties, valuating them, especially in the multifamily space. Because if you're left with 3 and then 1, you lose out on a bid, and then there's 2, I find that people are like, well, I have to get that one. Just like we were talking about in the beginning with the depreciation. It's like, oh, well, I want to get the 1031. So they buy something that's maybe not as attractive as an asset. I think it's the same as I'm going to get a helicopter to depreciate it. Do you even like helicopters? It's this thing where you heard it and it makes sense. That's where I came up with it. But I feel like it could put people in an uncomfortable position where they feel like they have to, because they don't want to pay taxes.
Again, this is a conversation of, don't let the tax tail wag the dog. And in this scenario, when we have investors that we're working with who are at a point where they've got a good amount of equity, it is a conversation we enter into in determining what would be the potential, run your numbers, right? What would be the total potential tax that you would pay if you sold the properties? Do we have any recapture from depreciation that we would have to maneuver around? And what would be the potential tax savings if we went through a 1031 exchange? And in this, my recommendation, based on my own opinions and the experiences that I've had, is if you've got rental real estate, enter into a 1031 exchange. There are some time requirements, but at the very least, if you work with an exchange intermediary, at least the ones that we've worked with our clients, they provide you with more or less a portfolio of opportunities for you to invest in, because they're working with other people who are also trying to exchange property values, right? So they want to help you. But we've been in situations like you mentioned, Jonathan, where a client will enter into a 1031. they'll be able to transact on 2 out of 3 properties, but we've helped them reduce the tax into the 2 properties, and now we only pay a little bit of the portion of the total tax that we would have paid. And then you can stockpile that cash, go invest it into another property, and it'll turn out fine. You'll pay a little tax, but I see that. But again, at the very least, my recommendation, if you're an investor, go into a 1031 exchange. If it doesn't work out, you've already ran the numbers and you know what the estimated tax is going to be. And that will at least help you make the decision that you need to moving into it.
Yeah, and Mike said something important before, and I think this goes to part of what we're talking about. The regulations are there. You don't want an accountant who's trying to skirt past it. It's all sitting there right there in the regulations for what you can do. You're finding people who want to just match what's there and make it easy. And it really is. It's just about knowing the code and understanding what the right thing to do is. And that's the way to maximize it. I think anytime, like you said, if you're getting anywhere near the line, it's a bad idea because the code tells you what you can do. And it's not hard, but you have to know it and then relay it to someone, and then someone has to follow it. Again, working together. I feel like the partnership aspect, this podcast is about the mindful approach to real estate investing. And across the episodes, we've talked so much about partnerships. This is a great side episode for partnerships because your partnership with people who are helping you with your finances is so important because, again, like we've said the whole time, you're going to look back, you're going to pay more. Every time you pay too much, that's money you could be used to develop another investment or something else for your kids long term. So if there's another thing that you guys could think of where you think people are making mistakes right now in terms of real estate and accounting, what would it be? Maybe something that's more common to right now.
My recommendation is maybe not doing it. And I'm not maybe just talking about real estate. I know this is a real estate specific question, but I think we're in a phase economically, if you will, where people are feeling, what inflation is doing to their paycheck. People are feeling the cost of groceries and gas and what that's doing to their paycheck. And I think the only mistake is not doing something about it. If all you are doing is putting money into a 401k, you'll continue to feel that constrainment, that tightening, if you will. So as it relates to real estate, a big mistake is not getting into it. It's a hard asset. You can get cash flow on it from a monthly basis. It has the potential to save you money on taxes. But I've also seen clients use real estate as a way to pay for a child's education. I've also said, we talked about it last week, Jonathan. It's a way for you to help your kids get ahead in the world, give them some opportunities so that they can buy a house or they have cash flow when they go to college or they have good credit. I've seen people, instead of contributing to an HSA, purchase a property and use the property to help pay for medical expenses in the event that they have to have something to help them pay for medical expenses. So there's lots of, and it might not even be real estate. Maybe it's a side hustle that you've had a little bit of opportunity making a little bit of money on, that if you just spent some more time or implemented some processes, that you might be able to make even more money doing it. So I think, again, from my comment, the biggest mistake is just not doing it.
Yeah. Like it. Mike, what about you?
Yeah, I'll kind of add to that just by saying that no one ever got rich by cutting costs. You can say, well, we're in a bit of a tight time right now. Inflation is hurting, or maybe you're a little worried about where the economy is going to go, and say, well, if I just cut costs, then everything will be all right. And whether that's in a business or individually, you can only cut costs so much. There is a limit to how much you can cut costs. There's no limit to how much you can increase income. And real estate it's an amazing way to both cut costs and increase income. Because of the tax savings that you have, it allows you to cut those costs from your taxes. But, the income that you get is multifaceted. It's, you get that monthly recurring revenue from whether it's a rental, a long-term rental or a short-term rental, you're getting that monthly income. But you also get the appreciation of the property. So, if you're in a position where, and this is where I want to kind of circle back to what I said at the beginning, you need to buy when it's right for you. I actually often have people ask me, and I've had this for years, when the economy was booming and even now when it's slowed down a bit in the real estate market, people say, well, what do you think? Like, is it a good time to buy right now? at the end of the day, it has to be a good time for you. If you've got the cash available and you find a property that you know you can cash flow, you do the comparisons of what the rental rate is around in the market, and you say, okay, well, I can get a mortgage for X amount and I can rent it out and actually make a profit on this. If you're in a position where that makes sense for you, then yes, right now is a great time to buy. However, if you do the comps and it's like, well, I'd be negative X amount of dollars, then it's not a good time. So don't buy. So what I would say is keep doing your research, find a place and a time where it does make sense for you to invest in real estate, and work on increasing your revenue, because that is how you're going to become wealthy. You're not going to do that by cutting your costs. You need to actually increase your income, and that's how you're going to build wealth.
Yeah, I heard something similar. It's really resonating. I think it was Cody Sanchez. I got it in her email letter, and she was saying, like, you're never going to get rich by not buying Starbucks each week. It'll save you money, but like you're exactly what you're saying. That's not the thing that's going to get you rich. You need the income, like you're saying. I love it. I mean, I think this is real practical advice, but also something that everybody needs to hear. You can get really busy as a real estate investor, buying properties, doing this. But what you're doing later on is going to be a problem. It's like nobody likes to think about their taxes, including me, until the last second. And then you're like, oh, shit, now I'm in trouble. I didn't realize that's actually really common for real estate agents, too, because you're not W-2, though. For 1099 employees, it's like push it till the end. And then you're like, oh, wait, I haven't paid, my quarterlies. Oops. Awesome. Guys, great job. Where is the best place for anybody to get in touch with you? At highcountryfinance.com?
Personally, the best place, if you have questions, if you want to reach out, if you would like to communicate with our team about a consultation or have us review tax returns, which we would do for free, the best place is Instagram. You can reach me at the Brady Slack. That's the best place probably to start with both of us, and then we can go from there.
No underscores?
At the Brady Slack. I got lucky with the name. It worked out good.
Yeah.
But we did actually just revamp our website. So if you do go to highcountryfinance.com, you can actually book a consultation on the website and see some of these podcasts that we've been on. We've got those featured on the website. So yeah.
Yeah, and we'll add your link tree, because I know that has all the different ways to get in touch with you guys as well. But yeah, I really appreciate it. These type of episodes are really here to help save people, including myself as usual. But that's the thing. I mean, I think it's important for all the listeners to know, I've been doing this 30 years and I still screw up tax related real estate things just because I'm going so hot. I'm looking at properties, I'm doing all these other things in my life. But the goal of taxes, I want to protect it for my kids. I talked about it a lot, when I was on your podcast, Brady, about how my dad had it all together, but then he passed away, now 19 years ago. And I just haven't been, on the same tax trajectory because he knew about it. So these tips are really helpful. I hope the listeners check you guys out and get some good advice out there.
No, thank you for having us, Jonathan. I appreciate it.
Yeah, thank you very much.
Yeah, appreciate it. All right, that was Brady Slack and Mike Scicluna. This was episode 79 of Zen and the Art of Real Estate Investing. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.